So this is Chapter 2, Income Tax Basics, covering just simply the PowerPoint material that is already in your curriculum in more detail. So Income Tax Basics takes us through why do we need to file a tax return. We're going to look at the income tax process, as well as tax brackets, marginal tax rates, and how that is part of the process. Income tax basics around deductions and the non-refundable and refundable credits, and tie that into some of the benefits that are part of the reason why we help consumers to do their returns through the CVITP program to ensure that they get all the benefits and credits that they are entitled to. So let's start off with why do we need to file a return. First of all, filing a tax return is an obligation for anybody with earned income in Canada if they owe money to the governments. But many people that we will see at the Voluntary Income Tax Program clinics may not have earned income and certainly may not owe anything to the government. But they do want to file their return, or they should file their returns to ensure that they don't miss out on any of the refundable credits and benefits that they are entitled to receive through the provincial government or the federal government programs. But it also is a way of establishing eligibility for any of the other income-tested programs that are separate from the tax returns, but that rely on the tax information to prove eligibility to the thresholds. So let's look starting off with the tax brackets and income tax basics. So when we think about tax brackets means the various different points in an earnings of an individual that move them from one rate of tax to the next. Both the federal government and the provincial government will charge individuals tax on the income that they've earned. And how much that is collected will depend on a couple of things. One is where they live, because provincial rates are different from province to province, although federal rates are always the same. But it also depends on what is the actual level of taxable income that the individual has. So those things together will determine the tax bracket that the individual falls into. And marginal tax rate is a term that you will see referenced quite often on the UFAL software we'll be using in the tax clinics. And a marginal tax rate is what is the rate of tax that's going to be applied on the next dollar that an individual might earn. And it is determined by adding together the federal rate and the provincial rate to determine what is the rate of tax that the individual is going to pay. So this is giving you an example of the tax brackets in Manitoba, where we combine the federal and the provincial rates together. And we can identify here the level of income at which the threshold changes and a different tax bracket is applied, as well as what those tax rates are when we combine the federal and the provincial rates. So here in Manitoba, anybody who lives in Manitoba can earn in 2020, and this does vary by year, $33,389, and any portion of that is taxable will be taxed at the rate of 25.8%. Anything that is earned over $33,389 up to the next threshold, which is $48,535, that portion of earnings would be taxed at a higher rate of 27.75%. Many people make the mistake of assuming that if they move into a higher threshold, a higher tax bracket, that means 100% of the income that they have earned is now going to be taxed at that higher rate. And that is not the case, as we have a progressive tax system, so you are taxed at a progressively higher rate only on the earnings that go up and above into the next thresholds. So somebody with a $34,000 income is in their marginal rate is in the 27.75% tax bracket, because the next dollar earned would be taxed at that rate. But the first $33,389 they earn would be taxed at the lower rate of 25.8, and it's only the difference between $33,389 and $34,000 that would be taxed at the 27.75% rate. And just because we can see what tax rate somebody might be in based on their total income earned, that doesn't mean that that's exactly what they pay, because there are many other calculations that are going to determine how much they actually end up having as taxes payable. And this visual here gives you a bit of a 30,000-foot view of the overall tax process that we are walking somebody through as we do their tax returns for them. It begins by establishing what is their total income from all sources. In Canada, you are taxed on your world income from all sources that is not exempt from tax. And from that, we will then determine, are there some legitimate tax deductions that can be subtracted from the total income to generate a lower net income and a lower taxable income. Once that taxable income is determined, then the tax rate that we just talked about, federally and provincially, is applied against that taxable income to determine your taxes payable. Again, that doesn't mean that's what the government gets. That's your taxes payable based on the income you've earned, but you may be able to reduce your taxes payable as a result of having offsetting tax credits that you can apply against those taxes payable in the form of either non-refundable credits or refundable credits. Once those have been applied against the taxes payable, that will determine whether or not there is a refund or a balance owing. A refund would be coming when the taxes payable are less than the refundable credits. The taxes owing would happen as a balance owing if the taxes payable are still higher than the refundable credits that have been applied. We'll look at each one of these categories in much more depth as we work through individual chapters and as we see the lived circumstances of the clients and the case studies we'll do, and we'll see how that applies to the different scenarios and the different components of the tax process to yield different outcomes. So again, tax deductions are going to be something that reduces taxable income. Non-refundable credits, on the other hand, are one of the things that can reduce the taxes payable. A tax deduction and a non-refundable credit are two entirely different things. And for many of the clients that we will serve, this is a difficult thing for them to understand because it's hard for them to wrap their mind around the fact that having an eligibility for a non-refundable credit doesn't automatically translate into a significant refund. Since non-refundable credits reduce taxes payable, if the individual already had zero taxes payable because they had zero taxable income, having more non-refundable credits is not going to give them a refund because you can't get less taxes payable than zero. And so having more non-refundable credits can't reduce it past the point of zero. And so this can be often a very difficult thing for clients to understand. Why is it not making a difference on my return to have a disability tax credit, but on my friend's return, it does make a difference. They have earned income. I might be on social assistance. And being able to explain that to the client is part of what we will help you understand as we work through the tax process. Refundable credits, though, are different. Refundable credits can reduce taxes payable. But if there are more refundable credits than there are taxes payable, then whatever's left over can come to the client as a refund, even if they had no earned income. So there's many different scenarios of situations here that can yield a refund that we will walk through as we look at the different client scenarios in more detail. But let's look in a little more detail at tax deductions first of all. So those tax deductions reduce the total income to give you a lower net income or lower taxable income. And when you have a lower taxable income, which is the income against which the tax rate is going to be applied, the result will be that there will be less taxes owed if you're able to lower that taxable income. But tax deductions will not result in a refund if the person has no income or is not taxable. So having more deductions may lower your net income, may reduce your taxable income to zero, but it isn't going to generate a refund if you have more deductions than you need to get that taxable income to zero. Some of the very common deductions that we will see in the tax returns that we do for clients will be often shown on a T4 slip from employment. Things like the registered pension plan contributions, which will end up on line 20,700 as a deduction, and it's shown in box 20 of a T4 slip. Registered retirement savings plan contributions, which are made directly by a client to their financial institution or investment advisor, and that will be shown on slips from the various organizations and will be reported as a deduction on line 20,800. And union and professional dues, which are shown on a T4 slip in box 44, and they end up as a deduction on line 21,200. So these are some very common tax deductions that we will see on the returns that we are processing for individuals. Then the tax credits that are part of that overall tax process, non-refundable or refundable, are the two kinds of tax credits that we will be seeing as we're doing returns for clients. These are used to reduce the taxes payable. So a non-refundable credit will reduce the taxes payable if there is anything owed. But if you have enough non-refundable credits to either balance the taxes payable, or even when you have more than you require, once you get to zero taxes owed, having more non-refundable credits is not going to generate an additional refund for a client. And again, this is where it can get quite upsetting and confusing to consumers. Somebody who has a very low income or no income at all will see really limited financial value from having high non-refundable credits when it comes to their tax return, because they don't create a refund. One of our resource people who has vast amounts of experience in doing taxes and the CVITP program will often explain to clients that these are no refund credits, because that makes it really clear that having more doesn't give you a refund. So thinking of it in that sense of it's non-refundable credit, but it's a no refund credit, can often make it a little bit easier to understand for the consumers that we will be serving. There are both federal and provincial non-refundable credits. The federal non-refundable credits up until tax year 2019 used to be shown on the Schedule 1 of the tax return. They are now shown in Step 5 of the T1 General Return, which is actually on page 6 of the return. Provincial credits, non-refundable credits, are shown on the Schedule MB428. Most of the credits mimic one another. If there's a basic credit in the federal return, there's a basic credit on the provincial schedule. If there's an age amount on the federal return, there's an age amount on the provincial schedule. The amounts of each of those credits do vary. They're not the same provincially across the provinces, but they're also not the same between the province and the federal, but many of them will be mimicked in the different tax calculations. There are a few credits, however, that are only provincial, and there are some that might be only federal. So it isn't 100% that way, but the vast majority of the non-refundable or no refund credits you're going to see on both the federal and the provincial calculation. The most common ones that you will be getting used to seeing are the basic amount, which ends up on line 30,000 of the T1 General, and the amount is $13,229 for the 2020 tax year. The basic amount is essentially the amount that anybody can earn in Canada and not have to pay tax federally. It balances with the taxes that are calculated on that level of income, because the federal rate of tax is calculated at the same rate as the federal rate for the non-refundable credits, so they effectively balance each other out. The age amount is for anybody who is over the age of 65 by the end of the tax year, and the figure for 2020 will be 77,637, shown on line 30,100. These amounts all are indexed and change annually. Disability tax credit on line 31,600 is 8,576 for the tax year 2020. Eligibility to claim the disability tax credit comes only with permission by Canada Revenue, who has deemed you eligible based on your health concerns. More on that will come when we talk about medical expenses in Chapter 9. Medical expenses are also a common non-refundable credit that we will be indicating on tax returns for the clients that we see, and those will be reported on line 33,099. So those are some of the common federal non-refundable credits. And now I want to refer you to a bit of an example that's shown in your Chapter 2 tax curriculum. And this example is using the scenarios of James and Susan and how their eligibility for a disability tax credit on their returns makes a significant difference to one over the other, and why exactly is that the case. So I'll have you turn to that in your curriculum. It's on the 5th page of Chapter 2 in a box that is got an orange or peach colored background. So in that scenario, we'll see that James is the one individual who has income from about $11,000 solely from the Canada Pension Plan Disability Program. He has been recently granted the disability tax credit and has assumed that that was going to generate a very significant increase in his tax refund when he files his tax return. And he's surprised and disappointed to find that he only has an extra about $113 on his tax return. And he wonders why it's so low when he knows Susan down the hall in his apartment block has a much higher refund, and she's also just become eligible for the disability tax credit. So James doesn't have a significantly different tax refund in his scenario, because adding that disability tax credit of $8,570 some for this tax year really doesn't do anything to his situation because his income of $11,000 was already lower than his basic amount of $13,229. So he's already paying zero taxes as a result of having more non-refundable credits than he has income, even before the disability tax credit got added in. So he sees very little difference to his tax refund. In fact, that $113 difference is really solely as a result of being eligible for an extra refundable credit in Manitoba as a result of having the disability tax credit. Susan, in the example, though, is in a bit of a different scenario. She has earned $20,000 from employment over the tax year, and she has now also just become eligible to claim the disability tax credit on her tax return. And she has received a refund that is significantly higher than normal, roughly $2,000 more than she's normally received. And she wonders why she's got more than James does. And the reason for that is because Susan's income was $20,000. Up until she became eligible for the disability tax credit, she'd only been receiving the basic amount, which was $13,229. So she was taxed on the difference between what she had as no refund credits and what her income was. Adding the disability tax credit of over $8,500 to her return increases how much her non-refundable credits are, to the point where now it's over $21,000. Now her income is less than her total of the no refund credits. And so she has had tax taken off her paycheck throughout the year on the assumption that she only had the basic amount that she was going to be able to claim on her tax return. When the tax return was filed in this first year of being eligible to claim that disability tax credit, she now has had more tax submitted to the government than was needed because she has a higher level of non-refundable credits to balance that income. And as a result, she's getting back the money that had been given to the federal government right off her paycheck all along. And that's why she has a much higher refund this year. Going forward, Susan can actually go to her employer at the beginning of the year and say, I'd like to change how much tax gets taken off my paycheck because I can claim this disability tax credit on my tax return. And the employer can start legitimately taking less tax off her paycheck, so she has more to live on month over month, but she won't have a large refund at the end of the tax year. And so that's why there is a difference between the situation with James and the situation with Susan, even though they each now qualify for the same credit. But because it is a no refund or a non-refundable credit, we see less of an impact for James, who is already non-taxable, and more of an impact to Susan, who did have a taxable income that she had to be concerned about. Refundable tax credits are the other type of credits that are deducted from the taxes payable in our overall income tax process. And refundable tax credits are something that can generate a refund for a consumer even when they have no income to claim. There are both federal and provincial refundable tax credits that can be available. Each of the credits are calculated on a separate schedule as part of the U-File tax software, and when you're in the software, you can look schedule by schedule to actually see how the credits have been calculated to get those details. The eligible amounts of refundable tax credits get reported on the last page of the T1 General, which is now page 8, generally on the lines from $43,700 to $47,900. The total of those amounts added together are subtracted from the taxes payable that has been calculated based on the marginal tax rates and the income level of the individual. If there is more in the way of refundable credits than taxes payable, the client will have a refund. If there are more taxes payable than there are refundable credits, then the client will still owe Revenue Canada. There are different kinds of refundable credits, and we will get into the details of each of these as we work through the chapters in our curriculum and see the various different tax scenarios. Federally, there are some that are paid as part of the refund, and there are some credits that are provincial as well that are paid as part of the refund. So the federal credits that are paid as part of the refund that are most common include overpayment of taxes, Canada Pension Plan or EI premiums, that are withheld at source from an employer. So in the example I gave about Susan, she had more tax taken off at source than was required once she was able to claim the disability tax credit. That came back to her as a refundable credit. Many times when clients have more than one employer, each employer might be taking the Canada Pension Plan and the EI premiums off at the same rate, and they can easily end up with an overpayment as a result of once those are added together. Any overpayments in those areas will also come back as a refundable credit. And there is a federal refundable tax credit called the Canada Workers Benefit, formerly known as the Working Income Tax Benefit, that is a refundable credit to low-income earners who are employed or self-employed. There's actually a new one that will take place for the first time in 2020, and that is the Canada Training Credit. More about that in the sessions to come. There are also provincial refundable credits that are paid as part of the refund. The most common ones that we see are the Manitoba Personal Amount, the Manitoba Education Property Tax Credit, and the Primary Caregiver Amount. It is not uncommon to hear a client come in and say, as they are doing their tax return, I'm here to get my cost of living and my rent credit. What they are really meaning is the personal amount, which is often known as the cost of living credit, and the Education Property Tax Credit, which is also known by some as the rent credit. So that's part of what we would help people to get when we're doing their returns. But that's not all that we do as we are working with clients to help them get their tax returns done, because tax returns and the income that's reported on that becomes a really important doorway to access other benefit programs that are income tested and that rely on the tax information to prove eligibility for other benefits. So here's what that whole process looks like. Starting off with filing the tax return through the CVITP program, which identifies the income level, provides notices of assessment, or in some cases option C, proof of income records from Canada Revenue or access to prove income level. That may then mean that those individuals are also going to be able to get various different tax benefits paid quarterly or monthly, depending on the situation. But it also can mean that there are other programs that they might be eligible for where there's separate applications needed in order to qualify. So the tax benefits that are paid directly by the government agencies that may come multiple times during the year that are simply because the return has been filed include the federal benefits in the form of the goods and services or the GST tax credit, which is paid quarterly, and the Canada Child Benefit that is paid monthly. Both the GST and the Canada Child Benefit reset every July following the tax year. So if you file a tax return for the most recent year, then starting in July, a new benefit payment will happen based on the income that is shown on that tax return. If you've not filed a tax return by the deadline, then there will be no continuation of those benefits come July until that return is filed. But there are other income tested programs as well that may be applied for as a result of having filed the tax return and separately applying for these other benefits. More information on those will come when we do the access to benefits training closer to the tax season. Federally though, some of the programs that are most common are the Canada Learning Bond, which is a free education savings plan through RESPs paid to low-income or modest-income families with children born after the 2004. This can have up to $2,000 in free money for post-secondary education paid to low-income families. It requires not only the filing of the tax return, but other steps that need to take place in the process to open RESPs and apply for the Learning Bond as well. But there are other supplementary benefit programs for seniors in particular, who through the Old Age Security Plan, which include the Guaranteed Income Supplement Program, the allowance for a spouse or the allowance for a survivor for individuals who are between 60 and 64 or over 65, depending on the program. If those programs have not, or if those, if the tax returns have not been filed, then any continuation of benefits for those programs will also cease until the tax returns are filed. Provincially, there are other programs that may require separate applications that can generate income for individuals and families. There is the Manitoba Child Benefit Program and the Prenatal Program. There is also a 55 plus income support program, Rent Assist, and the School Tax for Tenants 55 plus, which are all benefit programs that can help to improve financial well-being for eligible individuals, and they are all based on the proof of income that is shown on the tax return. So not only having the tax return completed, but having it completed accurately is going to be essential in making sure people can access benefits that they are entitled to. As we finish up this chapter, I just want to refer you again to the resources that we have linked for you both in your Google Classroom as well as in your curriculum. One of those particular links that is very good is the CVITP training site created by Canada Revenue Agency, with everything from basics on tax concepts, much like we've covered today, how to download U-File, how to make sure to register as a volunteer, details on the use of virtual tax filing, sanctions through Canada Revenue for those who are eligible. But there's also very good information on there about different types of tax scenarios that you can work through and review to get more detailed information. We will cover all of the different main categories that we will see in a CVITP clinic as we work through our curriculum here, but it's always a good idea to have an additional resource to test your knowledge and understanding. At the moment, all of the information that is on there is relevant to the 2018 tax year. It hasn't been updated for 2019 yet, but that will likely happen in the very near future. So I'd encourage you to take a look at that. Also, at the very end of the tax curriculum that you've been provided through us, there are a list of links and other resources for information from the family and benefits calculators to filing tax returns for Indigenous individuals, where there is exempt earning. That also might be very good references for you to look into other information. So we'd encourage you to take a look at that. And then lastly, as you finish this chapter and before you begin going through the information from Chapter 3 or joining us in our Google Classroom, we would encourage you to make sure that you go into your Google Classroom to do the knowledge review questions that are relevant to Chapter 2. There is no case study to do for Chapter 2 yet. That will start with the Chapter 3 process, but there is a knowledge review set of questions for Chapter 2 for you to go in and just test that you've got understanding of the material that we've covered from the 30,000-foot view, as I say, and we'll dive deeper into the individual information as we work through the various different chapters. So that is all for Chapter 2, and we look forward to seeing you in Chapter 3.